Okay, we'll start with one of the 7 methods I'm going to describe here. And the first is what I call the Motley Fool Method. And these are my own sort of summaries. This is not like some technical thing you're going to go like read on your Series 7 exam or whatever. There is no official Motley Fool Method. But I call it that because when you get into going to do research, you run into a lot of like what are called newsletters. Different companies put out different newsletters where they recommend stocks and so on. Now, the Motley Fool is one I've always subscribed to, and I know a lot of people do. And they have sort of a method, of when you buy their newsletter, their basic general gist is that they say you should invest in 20 to 25 individual stocks, businesses that well researched, show promise for one reason or another, show good management, good statistics on the possibility of success. And that's what you should solely do. You shouldn't do a combination of stocks and bonds. You shouldn't do ETFs. You should invest in 20 to 25 individual companies. And wouldn't you know it, the Motley Fool newsletters help you to pick those 25 companies. And sort of their flagship newsletter gives you a list of potential stocks, and it's always coming out with new buy recommendations, but it does also kind of give you a minimum like 10 stocks that they call fundamental stocks or beginner stocks or whatever. If you're just getting going, like start buying these 10 first. And so this would be considered like on the risk spectrum, like pretty risky, really. I mean, it depends who you talk to in terms of like what this would be considered on the risk spectrum. I'll do a video on the risk spectrum, or what I call the risk spectrum. Because just investing in 20 to 25 stocks, you're not really getting a lot of diversification that way. And when you concentrate your savings into one particular area, i.e. stocks, there's an argument that your risk goes up. Now, Motley Fool also does, kind of say you need a little bit more risk to get a little bit more reward. They tout that they beat the S&P 500, which is, kind of the standard benchmark of performance. And the S&P 500 is like, 500 largest companies in the U.S. as an index. And roughly speaking, historically, last 100 plus years, if you were just invested in the S&P 500, you would have gotten a compound annual return of about 10% with reinvested dividends. Motley Fool says we beat that. We actually get you a higher return. We get you to where you want to go faster. Here's my problem with the Motley Fool. They say invest in 20 to 25 stocks, but their newsletters combined probably cover 500 stocks. And then the minimum stocks, the fundamentals, the basics, it's like 10 stocks. So you're basically at your own devices to pick which of the 25 stocks you're going to get out of like hundreds, right? You could very easily pick the wrong thing. So I'm always thinking when I'm looking at the Motley Fool, like, well, which one do I pick? I don't know. Like, can't you just tell me the 25 stocks and like leave it at that? Well, that would be nice, but of course that wouldn't be much of a business. They need more newsletters to sell to make more money. They need more this, that, and the other to make more money. So that's my problem with the Motley Fool thing. And it's like some people pick the right ones and do better. Some people pick the wrong ones and do worse. And it's tough. Now, what Motley Fool has done that I think is cool is since the invention of exchange traded funds, meaning you can take like a fund that's managed by a person or a team of people, like, they say, we're going to invest, our fund likes to invest in these investments. We think these are the best. Motley Fool has a couple of funds. One is like their, kind of Motley Fool 100. It's like their best collection of 100 stocks. You can buy all 100 through the ETF and just take the guesswork out of it. And I ended up deciding to do that. I own the Motley Fool 100, and I also own the Motley Fool small cap fund now. They have about 5 funds, 2 passively managed, 3 actively managed, I think. So So you can work with Motley Fool and kind of do their method, a couple of ways. But it's funny. I'm like, well, you made a fund and you put 100 stocks in it. What happened to the 20 to 25 stocks thing? So, there's contradictions like that all over the financial industry. What can you do? But that's one method. And generally, I like Motley Fool overall. I'm a fan.